which need to be taken for preparation of cash flow statement. So cash flow statement, cash is taken. That means fund means cash, which is a narrow concept. Now, coming to the basis of accounting, which is followed under the uh, fund flow, is the accrual basis of accounting, whereas in the cash flow, we are based on the cash basis of accounting. Now, statement of changes in working capital is required to be prepared under fund flow statement. Such kind of schedule or a statement is not necessary in case of cash flow statement. Now, coming to the statements which we are supposed to prepare under fund flow is, one is statement of changes in working capital. Then we have to prepare the sources and uses of funds. And also we need to know what are the funds from operations. So these are the three need to be prepared under the fund flow statement. Now coming to the cash flow statement, we require to prepare only one statement in which it is classified under three heads. One is operating, the next is investing, the third is financing activities. These are the three activities which are supposed to be shown in a single statement. So operating, investing, and financing activities are being considered. Now coming to the basis of usefulness, the fund flow statement is useful in planning the intermediate and the long-term financing. The cash flow statement is useful for the short-term analysis and the cash planning for the business. Coming to the improvements, the basis of improvements under the fund flow, the position of a firm does not necessarily to lead to the improvement in cash position. But whereas the improvement in cash position results in improvement of funds under the cash flow statement. Coming to the opening and cash balances, opening and closing balances of cash is not required to be taken in the fund flow statement. Probably it has been considered under the statement of changes in working capital. Whereas under the cash flow statement, it's actually whatever the adjustments are being made, those adjustments are to be taken. Adjust with your opening balances of cash, and you have to arrive at closing balances of cash. Usually we call this term as a cash and a cash equivalence. So these two terms which are being mostly used under the cash flow statement. So these are the differences which we need to know from fund flow and cash flow. Only except the statement, all other accounts like hidden information which need to be known, that you need to prepare, you need to open all the accounts and you need to know. And the cash flow statement, which is to be prepared under as per the Companies Act, which is a necessary, which is a mandatory, that cash flow statement need to be prepared, where fund flow statement is not mandatory. So it is to be prepared as and when the management wants it. But the cash flow statement supposed to be prepared at every year because it is a compulsory need to be prepared. The next, the cash flow statement is being followed according to the standards, the standard 3, which is been given. Taking that as a base, we are supposed to prepare a cash flow statement. Now, as I told you, cash comprises of cash on hand, demand deposits with bank. Cash equivalence is known as short maturity, maybe within 3 months or less than 3 months from the date of acquisition or investments in shares, are excluded from cash equivalents unless they are substance cash equivalents. For example, the cash equivalents you can, which are redeemable in shortly, those things can be taken under the cash equivalents. The next, coming to the cash flows, that is inflows and outflows of cash, which is to be considered under the cash flow statement. As I told you, the classification of cash flows are being done under 3 categories. One is the cash flows from operating activities, cash flows from investing activities, cash flows from financing activities. The operating activities, that means what actually the main business of the company that we need to take into the account. So it may be operating capability of the enterprise, paying dividends, repay loans, make new investments without recourse of external sources. There can be a financial enterprise or a non-financial enterprise also will be taken into the account, like banking institutions, etc., where you want to prepare a cash flow. In such cases, they're lending the loans operation, no, accepting the deposits, lending the loans. That means interest received, interest is paid, becomes the operating activity. The non-financial enterprises, if you take into the account, then automatically their operating will be something more, something else. And whereas the interest payment or interest received becomes their investing activity or a finance activity. So it cannot come under the operating activity other than the banks. And the next, coming to the investing activities, like investing activities is the amounts may be invested for the purchasing of fixed asset. So whenever you're acquiring the fixed asset, it becomes a minus figure, or when you are selling the fixed asset, it is the inflow of cash. Purchasing the fixed asset is outflow of cash. Investing, that is selling of the fixed asset, becomes inflow of cash. So those things we have to take into the account and see to it that whether a plus figure is more or a minus figure is more. If it is plus figure is more, that means you can say cash flows from investing activity. If a minus figure, if you have, that is purchases are more. In such cases, you can say that it is cash flows are used in investing activities. In the same manner, coming to the finance activities, under the finance activities, you can see to it that shares, debentures may be issued, may be redeemed. So the sale proceeds from issuing of shares or debentures becomes a positive. And redeemable, that cash payments which are being made on maturity of redeemable shares or debentures, that becomes a minus figure. So whether a plus figure is more or a minus figure is more, that need to be taken care of. If it is plus is more, you can say cash inflows from the financing activity. If a minus figure is more, which need to be stated as the cash used in financing activities or cash lost in because of financing activities. Apart from this, we also need to take into the account the certain other things like interest payment and dividends payment. Now, interest received or paid, whatever may be, whether should be treated as a financing activity or an investing activity, or it comes under the operating activity. Those things you have to consider. Now, as I told you, the banking organization, payment of interest for the deposits which they have accepted or the loans which they have given, on that interest might have collected. Taking that as a base, the financing activity comes under the operating, whereas other than the financial activities or the enterprises, where it comes under their financing or investing activity as it is being stated. So basically, interest received, dividend received, interest paid, for financing enterprises, it is treated as an operating activity. For non-financial enterprises, it becomes an investing activity. Interest paid, if it is a financial enterprise, treated as operating activity. For a non-financial enterprise, it is treated as a financing activity. Dividend paid, which is treated as a financing activity in both, whether it is financial enterprises or a non-financial enterprises, it is treated as a financing activity. Now coming to the taxes, so whatever the arising the taxes on income should be separately disclosed and should be classified under the cash flows from operating activities unless they are specifically identified with financing or investing activities. In case any acquisitions or disposals of subsidiaries of other business units, if it has been taken into the account, even those things you need to see to it whether it should be classified as investing activities or any other, as per the information which is given in the problem. So these are the extra items which need to be considered in case of operating activities or investing activities and financing activities. So let us see the format for the preparation of could you able to see this is a format which we are supposed to follow for the preparation of cash flow statement. So now in the cash flows from operating activities, we are supposed to take, there are two methods we have, direct method and indirect method. The direct method, can you mute? Hello? Hello? There's a disturbance. Disturbance. Hello? So the format for cash flow statement to be taken into the account. So this is a format need to be followed. We have a direct method format and indirect method format. In the direct method, the cash flows from operating activities if you want to take, then cash receipts from the customers need to be prepared, cash paid to suppliers and employees, cash generated from operations, income tax paid, cash flow before extraordinary items, net. You have to see to it whether a plus figure or a minus figure, which is more. If it is a plus figure is more, you can say net cash from operating activities or the net profit before tax and extraordinary items. Hello? Any doubts? Then after operating activities, you need to see to it that investing activities to be taken. Under the investing activities, individual items of cash inflows and outflows from investing activities, cash, whatever, whether a plus figure or a minus figure, if it is more or less, that need to be considered and see to it that it is net cash flows or the net cash used in investing activities. The next, you can take into the account the financial activities. The financial activities, if you take into the account, the individual items of cash inflows and outflows from financing activities, such as the sale proceeds of issue of, that is whatever the proceeds which you receive when you are issuing the shares, the long-term borrowings, repayments of long-term borrowings, interest paid, dividend paid, etc., supposed to be considered under this individual items. So see to it that whether minus figure or a plus figure, if the plus figure is there, it becomes a net cash flows from financing activities. Once you add all these three, and you need to add opening balance of cash, which is shown in the balance sheet, and you need to arrive at closing balance of cash, which is already given in the balance sheet. This is a direct method supposed to be worked out. We have an indirect method. Under the indirect method, the cash flows from operating activity is the only one which is changing, relating to a direct method or indirect method. Whereas the financing activity, investing activity remains the same. Only operating activity, the procedure will differ in case of a direct method or an indirect method. Now coming to the indirect method, first you are taking the net profit before tax and extraordinary items. which need to be worked out. That is under working notes, you have to take into the account. And there is a need that adjustments of non-cash and the non-operating items supposed to be taken. So the items which are to be added here is depreciation is one. The next, interest on debentures, loans and borrowings, loss on sale of fixed assets, loss on sale of investments, provision for doubtful debts, provision for discount on debtors, preliminary expenses written off, amortization of assets, intangible assets such as goodwill, patents, trademarks, etc. written off. These are the items supposed to be added. Items to be deducted such as interest income, dividend income, rental income, the gain or a profit on sale of fixed assets, gain or a profit on sale of investments, appreciation of fixed assets. All this supposed to be deducted. After deducting this, we are supposed to after deducting that, we are supposed to see to it that operating profit before working capital changes. Now under fund flow, we are preparing separately, but here what we are doing, whether an increase or a decrease, to that extent, whether the cash will increase or a decrease, that we need to take into the consideration, and accordingly, those changes, those adjustments are to be made here. So here they say that decrease in current assets except cash or cash equivalent. So we are not considering cash or a cash in hand, cash at bank were not considered. Apart from that, what all we have, those current assets, if there is a decrease in current assets, that means you will increase your assets. That is cash. Decrease in current assets will increases the cash. So decrease in current asset need to be added. Increase in current asset will decreases your cash, which is to be deducted. So that you have to remember. Decrease in current asset increases the cash. Increase in current asset decreases the cash. That means current assets are inversely related to the cash. So that you need to take into the account. Decrease in current assets such as decrease in inventory or a stock, decrease in trade receivables, debtors and bills receivables, decrease in prepaid expenses, decrease in accrued incomes. Now, increase in current liability, decreases your cash, and decrease in current liability will increases your cash. So always remember, increase in current liability will increases your cash because you are not paying that liability at all. So increase in current liabilities such as increase in trade payables, creditors, bills payables, increase in outstanding expenses, increase in income received in advance. So current liabilities are directly related to the cash. Current assets are indirectly related to the cash. So that you have to consider what are to be added, what are to be deducted, that you have to decide, see to it whether the cash will increase or decrease because of an increase or a decrease in your current assets and current liabilities. Those adjustments are to be made. Once those adjustments are being made, automatically you will be able to get the cash generated from operations. Once you're getting the cash generated from operations, then deduct interest tax paid, which is a tax refund which is received, that need to be deducted, and cash flows before extraordinary items you'll get. For that, you have to adjust the extraordinary items, and after adjusting that, you will be able to get net cash flows from operating activities. Now coming to the cash flows from investing activities, proceeds from sale of fixed assets, proceeds from sale of fixed assets like intangible assets and tangible assets. Tangible assets like building, machinery, etc. Intangible assets like goodwill, patents, etc. Proceeds from sale of non-current investments, interest received, dividend received, rent received, purchase of fixed assets, purchase of fixed assets like goodwill, purchase of non-current investments. Purchases is always a minus figures, sale proceeds or interest received, all that inflow of cash. Inflow of cash is positive, outflow of cash is negative. Then this adjustments, if it has been made, then you will be able to know whether it is a net cash flows from investing activity or net cash used in investing activity. So whether plus figure is more, it is called as net cash flows from investing activity. The next category which we have to take into the account is cash flows from financing activity. So sale proceeds, that is proceeds which are being received from the issue of shares and debentures, proceeds from other long-term borrowings and loans, raising of bank overdraft and cash credit, repayment of loans and other long-term borrowings, payment of dividends, interest on debentures and loans, redemption of preference shares and debentures, payment on buyback shares, all this comes under your financing activity. So see to it that whether cash flows maybe from financing activity or used in financing activity, that need to be taken care. And for this, you have to add the opening balance of cash and deduct the, that means you have to arrive at the closing balance of cash, which is been stated in the balance sheet. This is specifically mentioned the format, and we are supposed to work out the problem according to the format. That means strictly we need to follow the format. We cannot be deviated taking this format as a base. So this is a must need to be followed. So this is how you are supposed to prepare the cash flow statement. So whatever the problems which are being stated in your instruction material, taking the instruction material as a base, I think you can work out taking this format as a base. Any doubts relating to the cash flow statement? If no doubts are there, then I'll move on to the next statement, that is, we will go to the managerial decisions. Shall I move on to the managerial decisions? Marginal costing and managerial decisions is the next chapter or the next block which is supposed to be considered. So let us move on to the next is the marginal costing. So as you know, what is marginal costing? Now, the definition of marginal costing, which is being defined by the Chartered Institute of Management Accountants, define the marginal cost. The marginal cost is the amount at a given volume of output by which aggregate costs are changed if the volume of output is increased or decreased by 1 unit. That is about marginal cost. Now coming to the marginal costing, which is again defined by CIMA, is the ascertainment of marginal cost and of the effect on a profit of changes in volume or a type of output by differentiating between your fixed assets and fixed cost and variable cost. This technique of costing, which presents a management the required information, enabling it to measure the profitability of an undertaking by considering behavior of cost. It is a distinct method for ascertainment of cost, such as either a process or a job costing or a technique in which only a variable costs are charged to the operations. So what are the features of marginal costing? The main features of marginal costing, it is a technique of costing which is used to ascertain the marginal cost and to know the impact of variable cost on the volume of output. All costs are classified into fixed cost and variable cost. Now, you have a semi-fixed cost or a semi-variable cost also. So variable cost are the cost which varies according to the production of units. If production increases, your variable cost also increases. If your production decreases, your variable cost decreases. But fixed cost never ever change taking your volume of output into the account. It remains the same. Now, coming to the valuation of stock. Now, valuation of stock or work in progress or a finished goods is done on the basis of variable cost. Now, selling price is based on your marginal cost plus contribution. So, sales minus variable cost gives you the contribution. Now, profit is calculated by deducting your marginal cost and fixed cost from the sales. Usually, we write it as like this. We usually write it as your sales minus variable cost gives you the contribution minus fixed cost, which gives you the profit. This is the equation. We always call it as equation of marginal costing. This is called the equation of marginal costing. Now, so before to start with marginal costing, we have one more costing called absorption costing. Absorption costing is a conventional technique of ascertainment of cost. That means it is a practice of charging all cost, both variable and fixed, to the operation or process or a product, is also known as a full costing technique. Now, it is very oldest and a widely used technique of ascertaining cost. Now, coming to the ascertainment of profit under absorption costing, they'll give an income statement. First, we have to take the sales. Sales minus the cost of goods sold. That is what we have to take under the absorption costing. So, first, we will say income statement under absorption costing. So, we can write here, the first we will take the sales and we will write the value minus cost of goods sold. So, that need to be deducted from your sales. The cost of goods sold, cost of goods manufactured rather, if you take into the account, under this, the direct material, direct labor, factory overheads, variable, fixed overheads, all that you need to take, that becomes your cost of goods manufactured, which is supposed to be taken into the account. For this, the value of opening stock and closing stock need to be adjusted. Apart from that, you also need to adjust under absorption or over absorption of fixed factory overheads or administrative and selling and distribution overheads need to be adjusted. So once the factory overheads has been adjusted, you will be able to get an item or the resultant figure need to be called as gross profit. For this, we will be deducting the administrative overhead and selling and distribution overhead, whether it is fixed overhead or variable overhead, put together those administrative overhead, office overhead, selling and distribution expenses supposed to be deducted. So you will be arriving at in net profit. You will be arriving at net profit. This is a procedure supposed to be followed under absorption costing. Now we have under the marginal costing also, we have the marginal costing. The income statement under the marginal costing, here we will take only the sales we will take. Now sales we will take minus variable cost we will take into the account. Under the variable cost, we will take only the cost which is incurred to produce the products. So here, direct materials, direct labor, we will take into the account, but we will not consider the fixed cost. We will take the whatever may be the variable cost incurred for the production, all that we will take, we will able to get as contribution. C stands for contribution. Now, from the contribution, we are supposed to deduct the fixed cost. Fixed cost relating to your administration, relating to your factory, fixed cost relating to factory, fixed cost relating to administration. So all those fixed costs need to be deducted, and in case the closing inventory, opening inventory is given, then accordingly need to be adjusted. And see to it, only the variable cost will be taken first. And after arriving the contribution, deduct the fixed cost, you will arrive at profit. So this is a procedure which we will follow. This is a procedure which we will follow under the marginal costing. So you can expect the problems relating to an absorption costing and marginal costing. Now here they say the limitations of absorption costing, where it is difficult in comparison and controlling the cost. The cost cannot be controlled. Why? Because you are recording both fixed cost and variable cost. Next, it does not helpful in taking the decisions. The managerial decisions always based on marginal costing rather than the absorption costing. And they say that, see, the separation of fixed cost and variable cost in the marginal costing only is possible, but usually in all other categories, fixed cost, segregation of fixed cost and variable cost is not so easy. So automatically there is a limitation of unable to separate the fixed cost and variable cost. And absorption costing is not at all helpful for preparing any flexible budgets. Now coming to inventory valuation, under the inventory valuation also, absorption costing consider both fixed cost and variable cost. Under the marginal costing, it takes only the variable cost. It will never consider the fixed cost. So considering the fixed cost happens to be a limitation. That's the reason why there is a need to implement the marginal costing. So they always say fixed expenses remain constant in aggregate amount and do not vary with the increase or a decrease in production up to a particular level of output. So fixed expenses per unit continue to vary with the increase or a decrease in production. It is per unit, it may increase or decrease, but total amount remains the same. That is the reason why. So first of all, we are eliminating the fixed overheads, which leads to a different cost per unit at different levels of production. And that is the reason why a special technique known as a marginal costing has been developed, which excludes the fixed overheads entirely from the cost of production. Now, that's the reason why we are using the marginal costing. Now, coming to the even the marginal costing also have a limitations. The limitations is the separation of expenses into fixed and variable is definitely a difficult task, which cannot be stated as so easily being segregated. So it has its own limitations also. Apart from that, you have another one is the time taken for the completion of job is not given a due attention. Attention need to be taken into the account relating to the completion of task. A task which is completed immediately, a task which is unable to complete immediately, definitely has an effect relating to the ascertainment of cost. Then what kind of a technology which is developed so that fixed expenses have increased and their impact on production is much more than the impact of variable expenses. That is also need to be considered. The next, they say the marginal costing technique may value work in progress and finished stock at marginal cost, but they will never ever consider the fixed cost into the account. Now, and also another difficulty which is involved is the apportionment of overheads. Now, fixed expenses supposed to be allocated in such a manner that you should follow a particular method how to segregate the cost. That becomes a problem. Apportionment of overheads becoming a problem under the marginal costing technique. And another technique called, that is another limitation is, now marginal costing technique is difficult to apply in contract or a shipping industry where the value of work in progress is high in relation to turnover. So that is high there. The technique which is applied is very, very difficult. Cost control can be better achieved with the help of other techniques other than, like budgetary control can be applied, standard costing can be applied, but marginal costing technique does not provide any standard for the evaluation of performance. So that is the reason why it is the limitations. Now, technique which is not suitable for external reporting, that is for tax authorities, marginal income is not considered as taxable profit. So these are the limitations of marginal costing. Now, apart from that, we have the assumptions supposed to be taken under the break-even analysis. Now, break-even analysis, a point where your sales equal to your total cost, then it is called as a no profit, no loss point, which is also called as break-even analysis. Now, to prove a break-even analysis, so in the narrow term, it is called as a break-even analysis. In the broader term, we can call it as the cost volume profit analysis. Now, it is a relationship between cost, volume, and profit. Now, the assumptions which underlying the break-even analysis are fixed costs remain unchanged at all levels of activity. Variable costs change in direct proportionate to the volume of output. Costs can be classified into fixed and variable elements. Selling price remains constant irrespective of volume or production. Price of raw materials, labor rate, etc. remains constant. All these are the assumptions supposed to be taken to prove the break-even analysis. Now, where actually the break-even analysis are being used, now it helps in determining the selling price, which will give a desired result. It helps in forecasting the cost and a profit as a result of change in volume. It helps in fixing sales volume to cover a given return on capital employed. It also helps in determination of cost revenues at different levels of output. It studies the impact of increase or a decrease in fixed and variable cost on profit. Interfirm comparison of profit is made possible. Now, coming to the CVP analysis, under the CVP analysis, as you know, the marginal costing equation we will take into the account, that is sales minus variable cost, which is equal to contribution. Contribution minus fixed cost, which is equal to profit. The next, what is sales? Sales, you know, it is a revenue which is obtained after selling the goods, selling the finished goods in the market. Variable cost is a cost which varies according to the production. If production increases, your cost increases. If your production decreases, your cost decreases. Then the difference between a sales and a variable cost, we will name it as a contribution. contribution is excess of sales over the variable cost. The next is fixed cost. That means the total cost is segregated into variable cost and fixed cost. As I told you, variable cost is a cost which varies according to the level of activity. The fixed cost is a cost which doesn't vary according to the increase or decrease of production. But per unit, automatically it varies because always the total fixed cost divided by the total number of units produced, then accordingly the unit rate will change. Now, once the fixed cost is deducted from the contribution, then you are able to arrive at profit. Right? And now, usually this is how we will take into the account. Now, there are certain formulas supposed to be used in calculating the BEP in units, in sales, etc. Let us go for the whiteboard. Now here, now BEP in units, BEP in sales, BEP in units, your fixed cost divided by CPU, contribution per unit. How do we get contribution per unit? That means your sales minus variable cost per unit. Selling price per unit minus variable cost per unit gives you CPU, contribution per unit. In case if you want to calculate BEP in sales, then it is fixed cost divided by PV ratio. So how do we got PV ratio? The PV ratio is equal to your contribution by sales. The contribution is nothing but your sales minus variable cost divided by sales. This into 100 if you multiply, you can express PV ratio in percentages. So BEP sales can be worked out in fixed cost divided by PV ratio. And we may have, like after calculating the BEP sales can be calculated, that is BEP units into selling price per unit, you also get BEP sales. Even that way also you can calculate. So whatever the information which is given in the problem, based on that, these formulas supposed to be applied. Now, apart from this, we also need to take the another formula, that is how a PV ratio. PV ratio, you know, one formula is contribution by sales. Another formula is change in profits divided by change in sales. This way also you can calculate. Like 2 years profits, 2 years sales, if it is given, then you have to take the change in profit divided by change in sales. You will be able to know PV ratio. So PV ratio can be worked out in any of the manner. The next we have a margin of safety. Margin of safety is your actual sales minus BEP sales is one way of working out. The another way is profit divided by PV ratio. So this is a formula which we have applied to calculate the margin of safety. So the next we can as well take into the account, this is a graph which can be represented. Now, x-axis represents the units. The y-axis represents the cost and the revenue. This is your y-axis. The sales, when units are 0, your sales are 0. Units increases, your sales will increases. This is your sales curve. Now, whereas this is your fixed cost. This portion, we will call it as fixed cost. Now, your variable cost starts from above the fixed cost, and this will be called as total cost. Now, this is a point which is touching your sales and your total cost. This is called as BEP. And this is, if you draw perpendicular to the x-axis, you can know the BEP units. If you draw it to the y-axis, then you will be able to know BEP sales. So wherever it intersect sales curve, intersect the cost curve, then it is called as a BEP. Now, this is an angle, we call it as angle of incidence. Angle of incidence. This is an angle of incidence. And here, this is a profit region. And this is a loss region. So, always remember, you need to see to it before break-even point, your total cost is above your sales line. And after BEP, your sales line is above your total cost. And the difference between your total cost and fixed cost is your variable cost. So this is the graph, the BEP graph, which we are supposed to considered. Now we have one more graph which is called as the profit volume graph. If this is followed, have you followed this graph? Then we'll move on to the other graph, that is the profit volume graph. This is PV graph. Profit volume graph. So this is your sales line. This is your loss. This is your profit. So your sales line starts like this. That means this is your BEP. This is your loss. This is your profit. This is your angle of incidence. Right. So this is called as a profit volume graph. Now this is also, you have to understand, taking this as a base, there are so many other problems which are being considered. As short problems are being given. So let us consider one or two which can be worked out. So like let us say, shall I rub this one? Shall we move on to the problems? Now fixed cost is equal to 2,40,000. Your variable cost per unit is equal to 15 rupees. Your selling price per unit is equal to 30. So he's asking us to calculate BEP in units. So BEP in units we are supposed to calculate, which is equal to fixed cost divided by CPU. So fixed cost is 2,40,000 divided by 30 minus 15. So that is 2,40,000 divided by 15. What is the answer? Can anyone tell me the answer? $2,40,000 divided by 15, which need to be, I think it is 16,000 units. You have to mention it as units because you are worked out taking the CPU unit as a base. Right. The next, if we are supposed to calculate break-even sales, then shall I rub this one? So we will move on to the next is BEP sales. So to calculate the BEP sales, now BEP sales is equal to fixed cost divided by PV ratio. That means PV ratio is equal to your fixed cost is 2,40,000. PV ratio is sales minus variable cost. 15 divided by 30, which is 1 by 2. 1 by 2 into 100. That means it is 50%. It is 50% is your PV ratio. 50%. 2,40,000 divided by 50%. Almost it is 1,20,000 is your BEP sales. Your BEP sales is 1,20,000. This is you have to write down in rupees. 1,20,000 in rupees. So BEP sales is like this. Now, the next he gave you a next problem which is given as you're required to calculate BEP volume using the following data. Profit is 5,000, 20% of sales. PV ratio is 50%. So now profit is equal to, shall I rub this one? Now profit is equal to 5,000, which is 20% of sales. That means sales is 100%. If sales is equal to 100, your profit is equal to 20. Right? Sales minus profit is your cost, which is equal to 80. So, now 20% of 100 is equal to 5,000. That means 5,000 into 100 divided by 20. It is 25,000. It is 25,000 is your sales. If sales is equal to 25,000, that again we can cross verify what we did is right or wrong. So 25,000 is the sales into 20% of it is 5. So it's 5,000, right? So 25,000 is your sales. Now PV ratio is 50%. PV ratio is 50%, then your BEP sales is equal to, let us work out. See, BEP sales is equal to your fixed cost divided by PV ratio. Okay. Now, BEP sales. How are we able to get BEP sales? We don't know here the fixed cost. Then in that case, like let us say, we know the sales. Here PV ratio is equal to contribution by sales. Sales into PV ratio is equal to contribution. Sales is 25,000 into 50% is your PV ratio, which is equal to contribution. That means your contribution, you got it as 12,500. Your contribution is equal to 12,500, right? And minus fixed cost gives you profit. Profit already we know is 5,000. Your fixed cost will be 12,500 minus 5,000. It is 7,500. So fixed cost we got, PV ratio we got. So let us work out now. Your fixed cost is 7,500 divided by 50% is PV ratio, which is equal to 7,500 into 2, which is 15,000 is your BEP sales. So he's asking us to calculate BEP sales. BEP sales we worked out, we got it as 15,000. So this is how you are supposed to work out short problems under the marginal costing. Is it okay? Any doubts? Are you following? Any doubts?
No, ma'am.
Are you following? Could you able to see the screen?
Ji, ma'am.
Are you able to see the screen?
Yes, ma'am.
Okay. Now, tomorrow I'm taking 2 classes at a time. That is 12 to 1, 1:30 to 2:30.
Okay, ma'am.
And Sunday, Roja Rani ma'am will be taking e-commerce from 12 to 1 to 1:30 to 2:30.
Okay, ma'am.
Okay. So tomorrow we will be completing your portion.
Okay, madam.
We are left with budgetary control and standard costing. 2 units.
Ji.
Okay. Any doubts?
No, ma'am.
Okay. Let me take your attendance. Shall I remove this?
Ji, ma'am. Ji.
Right, Nana. Thank you. We'll meet you tomorrow for 2 classes.
Okay, ma'am. Thank you, ma'am.
Thank you.